My name is Max Gagliardi, and this is the Talk Energy Podcast. If you're watching this video, take a moment, hit the subscribe button over on YouTube, or you can follow me on your favorite podcast app. If you'd left a review on Apple Podcasts, that would help the cause. You can also check out our weekly energy newsletter. That's Ancova, A-N-C-O-V-A, on Substack. And today's guest is Taylor Kirkland. Taylor is a longtime friend and colleague. We've worked on a lot of things together over the years, everything from on the upstream oil and gas and midstream side to Bitcoin mining, to a bunch of other interesting things in between. And this episode, we thought we would go into looking at how maybe a framework can be put together if someone's thinking about buying or investing in either operated or non-operated oil and gas production. Taylor is a reservoir engineer by trade and he's a whiz when it comes to this stuff. He can always break it down in a very easy to understand way for somebody like me who's non-technical. This is not investment advice, but this is simply the framework that Taylor uses. Taylor, thanks for coming on.
Yeah, thanks for having me, and appreciate the opportunity to talk about this side. It's something we're kind of looking at more and more, I think, as individually. So it's something that's kind of always on our mind right now.
Absolutely. Well, you always have a way of looking at different opportunities to buy production or buy wells and quickly getting to an answer on whether it passed the sniff test. There's obviously, you can go very deep into evaluating these types of properties, but I think the framework that you've outlined for this conversation is a really good, just kind of starter pack for people that are interested in it, or maybe even some people that have some experience, but want to get somebody else's point of view. Why don't you start it off just from like the mineral side and just kind of how you have to start evaluating things in terms of ownerships and stuff like that. We'll go from there.
Yeah, definitely. So the first thing is, what is the opportunity? What type of ownership is it that you're looking to buy? Is it a mineral interest? Is it an overriding royalty interest? Is it a working interest opportunity? So the minerals and the royalty interest are treated fairly similarly. They're not cost bearing. So, the operating costs aren't being weighed against your revenue. So it's a one stream deal. It's just revenue. It's not revenue and expenses. Obviously there's taxes involved, and there can also be some costs associated on the gas side, but it's never anything out of pocket. You won't necessarily be negative in a month on a mineral and override position, whereas in a working interest position, if there's a workover or the well went down, they had to go buy extra chemical or do something in a given month, there you have the potential to be to actually owe money in a given month. So kind of just a high level difference there between the two. I'm sure if you had
real quick on working interest. So some people may not know this, specifically when talking to, for example, some people in the Bitcoin mining space. They were asking about owning oil and gas wells. Explain the difference between an operator and a non-operated interest, and what a non-operated working interest means for somebody that may not be familiar with it.
Definitely. So non-operated. So in any given well, there could be 10 to 100 parties that own a percentage of that well. Every well is almost kind of like a partnership almost, where
right.
The operator is the one that's managing it. They essentially charge a management fee effectively in something called COPUS, which is kind of the cost that's you as the non-operator pay for the back office accounting and all those types of things, because, to operate and manage a well, there's certainly costs associated with it outside of what's happening at the well site. So, typically the operator of a well has north of 50%. That's not necessarily always the case, but they'll at least typically have the majority, unless there's some agreement worked out otherwise. But as a non-operator in it, you just own a percentage of it. You could own 10%, 5%, 1%, and you get your statements, your revenue statements every month, and your JIBs, your billings every month for the costs that are incurred for that time period. And so
it's basically like a JV. It's like each well
exactly.
has a joint venture where you've got different ownerships in that well. Explain just how that happens, right? Like, why are there all these fractional ownerships? How does someone go about becoming a non-operated working interest owner, but just some of the mechanics about how these, you explain what the structure is, but how do people get into these structures?
Sure. So how this would happen is you could have, just like surface real estate is broken up into different tracts, you could have a number of, let's say you in a section, a 640 acre section, which is a 1 mile by 1 mile in states like Oklahoma, North Dakota, Louisiana, and some parts are broken up in these 1 mile by 1 mile, 640 acre sections. So let's say in that section, typically one person is not going to own the entirety of the surface and probably not certainly not the entirety of the mineral interest either. And so what ends up happening is, that will be broken down between different parties. But when a well gets drilled, it'll be unitized. And that can go a couple different ways. And it's not necessarily my expertise, but I've got a lot of experience in Oklahoma. So what happens in Oklahoma is it gets, effectively that 640 acre section becomes a unit. And so if somebody owns 64 acres in it, they end up having 10% of that well. And so on and so forth. So that's kind of how it can get broken down. And so an operator will come in and lease up. Let's say you've got 3 parties in there that each have a third. They might lease 2 of the parties, but somebody else might come in lease the other third of it. So they will end up with a 1/3 non-operated interest in that well, and then the operator will have 2/3, and it can obviously be broken down in much tinier portions. Historically, you've seen a lot of that where a play is emerging and there's a kind of a rush to go lease all these mineral owners and from a bunch of different parties. And that's how you end up with these fractional interests, non-operated interests. And a lot of those groups, did these big lease plays, and they'll end up with a large position of non-operated assets. And sometimes operators end up with them too. They'll do a lease play. They'll lease one person, and maybe that surface and that those minerals end up in multiple different units. And so, they might have bought 100 acres, but 100 or 95 are in one unit, and then 5 are in the other unit. And now they've got a 5-acre non-operated interest in a different unit that they might not necessarily want at some point in time, and they'll exit that particular portion of the asset.
Right. No, that's good. And some areas like Oklahoma, right, it's more fractionalized, or in the Northeast, whereas maybe areas like in Texas where you've got these big ranch owners, they may be a single owner. They may own vast swaths of these minerals to where you lease from just one person. So it's kind of geographic dependent on how it's going to shake out. To your point, you may buy a package or, get a lease, and you've got small fractional interests. People do things like trade and swap. One guy may have some unit that you want in, and you might have in a unit that he wants in, so you can do trades, things like that. And then when it comes time to drill the well, and this is getting kind of beyond the acquisition aspect, which we're going to get into here in a second. But when it comes time to drill, these non-ops can either participate or not. And maybe this is a whole nother podcast on getting into the details there. Maybe get a land guy, Wes, or somebody on to talk about it. But let's go into, before we get into some of the nuts and bolts of how you evaluate it, talk about deal sourcing, the different types of ways that, there's the obvious ways you can find deals, but talk about how you think about deal sourcing. What are some of the ways that people can go about it if they were interested in acquiring properties?
Sure. There's some readily available sources, like EnergyNet is one that you just sign up for an account. You've got to be accredited. They do a little bit of checking on, your means to invest or to purchase assets. But that has a lot of small opportunities within it. So EnergyNet's one. There's another one called Oil and Gas Clearinghouse. There's another one, Energy Domain. That's a fairly new one. So those are kind of, publicly available to everybody type options. And outside of that, it can be tough, especially right now. I don't know. not necessarily like in the deal flow right now, but from what I've gathered, it's tough for even somebody that's in the space most of the time. So I don't have a lot of advice. It's one of those things where you hear something comes up. You've got to be able to act on it though. And so I think having some, base level of understanding of how to kind of move through a rudimentary evaluation, if you're a non-technical, non-professional, whatever, that would be really helpful to kind of knowing, okay, should I somebody off the cuff says, oh, I'm trying to sell, I need to get out, I need some cash, trying to get out, like that's something we bought not too long ago, was an opportunity where the guy, it was just kind of random, but he said, oh, I need some cash, I need to offload this asset. And so we worked it up and made an offer. And it's obviously, if you're one-to-one with the seller, your odds to get a deal done are much greater. So we tend to focus more energy on those types of opportunities than something on the online auction type sites. But
that's good. That's a good overview. I mean, I have people coming to me randomly, like I mentioned in the Bitcoin space, being like, hey, we want to buy wells. How do we go about this? I'm kind of like, it's a loaded question. You really need people that are connected in the space to just help you evaluate them, people that have a history and track record of evaluating deals. And, I'll even get people on Twitter randomly sending me direct messages and just saying, hey, I would love to invest in non-ops or buy a package of wells. And I'm kind of always like, you're probably better off just getting exposure through the public equities or some other type of vehicle. And that's not typically the answer they want to hear, but it's not for somebody that doesn't know what they're doing and that doesn't have experience. I would say that if you're serious about doing something like this, the best thing to do would be to partner or work with people that have experience in the domain. So that's just kind of just an FYI for people, but let's go into like looking at existing production. You maybe have, come across a package of wells, or whether it be through one of these auction sites or whether it be through a connection or somebody that you hear that has a package for sale. Just go into the different ways you're going to start evaluating this package and some of the tools that you use and the metrics and things like that.
Okay, definitely. And one source I should have mentioned, like attorneys can be pretty good sources of opportunities. They might have clients that, if you've got some attorney buddies that do work for oil and gas clients or people, wealthy individuals or individuals of any sort, I guess, that might have oil and gas assets, that sometimes that can be a good source of opportunities as well. So, but off the bat, you've got to figure out, is it a cost bearing or non-cost bearing, working interest, or is it a mineral or override? If it's mineral and override, it's a much simpler evaluation because you only have to work, half of the equation effectively. But the big one, off the bat, is it ownership within a unit, or is it wellbore only? And you can seen this a lot where and know some, experienced people that this is bit where they bought an opportunity and didn't do a little bit of due diligence and realized that it was wellbore only. So what that means is you only own in the wells that are already drilled and producing in that unit. And if somebody were to come back and drill additional wells, you wouldn't have any right to participate or to see any of that revenue if you were in a mineral or override position in that unit. So if it's wellbore only, obviously you're only going to evaluate the production stream, and you're probably going to discount it more than if it were not, because there's no upside. So maybe it's, if it's ownership across the unit and there's future potential, albeit maybe way out in the future, you might not necessarily say, I think I want to pay for those future locations because they're fairly unknown, but it might allow you to say, yeah, there could be, I might want to pay a lower discount rate as opposed to something where there's never going to be any upside. So That's kind of one thing to think about.
Right. So you're basically either paying for the cash flow stream that's there today that we know is going to be relatively predictable. I mean, there's always things that can happen to that cash flow stream, especially if it's an individual well. You've got operational and execution risk. But what you're saying basically is that that's one set of the evaluation where you're looking at the cash flows, the existing production, and then there's this alternative way to look at it where you can show future potential if you're not just getting the wellbore and you're getting the acreage. What is that future value? What's the potential value? And then how would you put value or assign value to that whenever you go into the bid is kind of the way to think about it. Okay.
Yeah, exactly. Great. So to walk through how to evaluate existing production, you want to know, you want to see some check stubs. So the revenue statements that interest owner is receiving from the operator. So you want, 3, hopefully 6 months of that. You're double checking the ownership of those wells. You want to look in there for, maybe what is gas today? $3.60, something like that. So you can't run it at $3.60 gas. You kind of have to make a choice on the strip deck, the pricing that you want to run in the future. But there's a couple things that go into it. Even if you have an override or a mineral position, there could be, the location where you are could have a basis differential. So you've got to check those check stubs, how much they're receiving for the gas and their oil versus what the strip price was at that point in time. So, in October, if gas was $7 and they were receiving $6, they're not going to be receiving. You need to take that into consideration as to how much they're receiving for their gas going forward. You also want to look for marketing and gathering and processing fees, because sometimes those can also be transferred on to a mineral owner. In a working interest scenario, those will definitely be transferred on. There's some scenarios where the leases are not or the mineral owners are not bearing any cost for any of that gathering and processing, and so all the delta on the pricing would be simply the basis differential.
Right.
And are there places where you can look? Are there online sources for looking at basis differential? You'd know more about that than I would. So
it's pretty tight to get that information. A lot of it's done by Platts, which is Gas Daily. That's a subscription-based service. In our newsletter, we'll average kind of in basin pricing to give sort of an approximation. We can't disclose the data because we're not allowed, but what we'll do is we'll aggregate a number of different index points, for example, for like Oklahoma or the Mid-Continent or the Northeast, or maybe like Texas regions, like the Permian. And we'll say, okay, like the average basin differential is this, to give people kind of a public view of what it looks like generally. But typically these are indexes that you have to pay a service to get. And so it's not exactly the most public information, and it can be a little bit hard to find. And I think that this is a really good time to talk about data quality, because the revenue side is where I have a lot of experience. And I think that there's a differing levels of data quality you can get. For example, if you're a royalty owner, like you mentioned, you may just be getting check details or check stubs that may or may not show you the rest of the deductions. It may not matter if you're not getting those deductions passed to you. You may be a non-operated working interest owner where you're getting some level of detail, still probably going to be some kind of a check stub that may have gathering, compression, processing, treating broken out. It may not. It may also not have all the product streams broken out. So You can run into the issue of where, like, gas was $3 that month, yet your check stub says $4.50. And you're like, how can it be $4.50? And you're like, oh, well, they're including natural gas liquids or NGLs in that price, which can make it even more opaque. And there's a lot of issues with trying to run these evaluations if you don't have a sense of what's driving that netback price, because there's just a lot of variables. And then if you're buying an operated position, this should be the highest quality of data. In this instance, you would expect actual, purchase statements that show how you were paid. I think it's very reasonable to request the contracts that are governing the sales of the product. And if you're buying an operated position, you should have the highest quality of data. And you can do the most thorough analysis, which is truly breaking everything down, actually building out your own stack of fees, deductions like fuels, things like that. And then you can apply that versus a future revenue stream. Whereas if you're buying minerals or if you're buying a non-op working interest, you really just kind of have a historical price, and you have to find a way to approximate how this relates to the index price or to Henry Hub, or which is the gas price, or for WTI for crude. And then you have to make some assumptions, and that can be one of the challenges, right? Is understanding where you're trying to cut through the noise. Right. How do you think about that? I mean, do you go back 6 months? Do you go back 12 months? I mean, what's the rule of thumb that you try to use?
The last 12 months have been pretty wild, so it's hard to typically I'd say like 6 months is probably fine, because over the last 3 to 4 years, outside of let's say a 12 to 36 months ago, it was fairly consistent. And with the run up the last 12 months and subsequently it running back down, it's hard to judge that. I feel like I'm actually leaning more towards, if I'm getting 12 months of something, I'm going all the way back to probably 9 to 12 months ago when gas was still in a fairly was in that $4 range or something, because you don't know, are they getting a percentage of the proceeds? Is it a POP? Are they getting a percentage of the revenue, or is it like where they're getting 90% of it, or is it a fixed fee deal? And so sometimes you can see that, like if you're running through and you see every month they're getting 40 to 50 cents less Henry Hub or less NYMEX, or let's say $2 less NYMEX if we're going, or WTI if we're going oil, and it's consistent, then that's what it is. Those are the fees. But if it's all over the place, you probably want to check what that percentage is every month and see if you can make more sense of it. But it's all that you're saying, like the data quality makes you more confident in how buttoned up your evaluation is. The more buttoned up your evaluation is, and the more confidence that you have in it, the more comfortable you are paying, let's say, a lower discount rate. And I don't know if, like real estate, everything's done on yield basis, and this is all done discounted. What I'm talking about is a discounted cash flow model. So, if you're buying a really high quality data set and some wells that you believe in that are operated, the market for that is varied over the years, but it's, let's say it's a 10% discount rate, PV10 to PV12 or 13, something like that. And it might be off.
For people that don't know, that would mean you would get a 15 to 13% internal rate of return. So the discount rate for this is kind of finance 101 is the same as what the internal rate of return is. So if you're buying something PV15, that's a net present value at a 15% discount rate. It should also equal a 15% IRR. Right. And you would typically look at that maybe unlevered, so no debt. And then you can add debt in there, and then you have less equity. And so you can show what your return on equity would be in a leverage scenario. But that's just some of the basics around the terminology. When people hear PV10, PV20, you're talking about the discount rate used in a discounted cash flow model. So just for people, FYI.
Right.
One thing that I was going to mention before we moved off of pricing was just the importance of basis and how that can change, how quickly it can change. I mean, we were working in the mid-continent in 2019, basis differentials blew out. And so even though Henry Hub gas price or the NYMEX gas price may look strong, there could be times where in basin, because of physical constraints, the price gets bid down. Typically basis correlates to the cost to move the product outside of the basin. So, it approximates around the transportation costs. As capacity gets tight, transportation gets bid up because it's more valuable because there's less room to flow. So it'd be like going down a highway or a turnpike, and they're like, instead of just paying the same fee every time, if the turnpike got really congested and a lot of cars needed to travel down it, they would actively bid that rate up. And so then your basis would blow out. And then things like weather can affect it. Things like, I mentioned supply or demand in terms of like weather events and, the demand pull, and then also the supply push, which how much volume is coming on. And so a good example of this year would be the Permian, looking at what Waha has done, which is an index price, and how rapidly it can move. And so it can go from being relatively healthy, tracking kind of in line where, where the NYMEX price is going. And then other times it can blow out, and you can see a significant discount to that. So if you're only looking back at 6 months, and that 6 months was a relatively stable time with not a lot of variance or a lot of volatility in the basis, then that could be a misleading indicator around what your future price is going to be. So again, these are just some of the complexities. It's not quite as simple as just looking at historical check details and comparing that to a price. You need some level of basic understandings of what the market dynamics are doing in that basin. Is that a fair statement?
Yeah, absolutely. Absolutely. And, you can estimate it and say, nobody has a crystal ball, but if generally can get a sense if things are getting better or worse as far as takeaway capacity, or, if activity is really ramping up as far as drilling goes, you're at a higher likelihood that those pipes are going to fill up, which would increase the basis differential. So, things like that, you can kind of make an educated guess, but
there's also futures on basis. They're not super liquid, so they're not always the best approximation, but you can get access if you have a bank or somebody that is willing to hedge for you. Some will offer basis differential hedges, and you can at least get an approximation around some of the more liquid sales points, like in the Mid-Continent, maybe like a PEPL, which is a Panhandle and Eastern Pipeline Index, which is a common one that goes to the Chicago markets. And you can look at that and say, okay, what does the futures look like on this? Today it's 25 cents, but next year it's 45 cents, which means the market is pricing in that basis is going to widen. So there are some things you can look at. They're not gospel, but they certainly can give you a better idea of where the prices may be going in that particular basin.
Right. For sure.
Great. All right. So that's pricing. There's a lot there. Again, just to recap, royalties and non-ops, you probably have less data operated. You're going to have a lot more data, which, to your point, gives you confidence around the bid. But it's not just price, it's also volume. So let's talk about the way you look. You're a reservoir engineer, so you've got a background in understanding reservoir dynamics, what wells typically do. Why don't you just kick it off, and we'll get down the rabbit hole on the reservoir side and the volume side.
Yeah, for sure. So the kind of the belts and suspenders approach, or is decline curve analysis, and so that's getting the production stream from a public data source. It's difficult sometimes, but it's available through the Oklahoma Corporation Commission or Railroad Commission. You can find states like North Dakota actually have incredible public data on their website. At least they did when I worked it. It was a few years ago, but so you can get data from that. If it's a couple wells, it's not so bad. If it's 100 wells, it's a pain. The best way, really, I like to use Drilling Info, or now it's in Veris, is a great way to just search. You can plug in the API numbers and pull them all up. With decline curve analysis and economics modeling, and get a discounted cash flow from that. I have trouble with it. I don't know what that says about me, but I use PhD Win. It's not an expensive program, relatively, and it's pretty user friendly. So if I were doing an opportunity, I would get all the API number. Every well in the U.S. has a unique identifier. First two numbers are the state code, then the next three are the county, and then the rest are specific. If you have those wells or the lease names or whatever, you can find them in something like Drilling Info, and pull them down, load them into PhD Win or Aries, or you could do Excel models as well. But so pull down the production, plug in the ownership that you've pulled off of the check stubs, and then you're creating a forecast. So forecasting those wells. Most of them, if it's older stuff, it's a straight line on a semi-log plot, so it's an exponential decline. So that's pretty straightforward. If it's newer wells, they're typically on what's called a hyperbolic decline, where on a semi-log plot they're curved, and there's a lot that goes into how much they curve or how much you should expect them to curve. It's what's called a B factor. Newer wells are tougher. You've got to do more research. You've got to look at older wells drilled within the same formation in that given area and understand what their future performance might look like. So investing in newer wells is not probably shouldn't be your first foray into oil and gas investing, right, unless you've got somebody that's helped you evaluate it.
So real quick on this point, for those who may not know, talk about how new wells versus older wells, legacy production, the decline profiles of those, and how it differs, and maybe just expand a little bit on that point you just made.
Sure, definitely. So newer wells, let's take a newer well, let's say in the Permian, it starts off at 1,000 barrels a day. After a year, it's probably at 300 barrels a day, let's say. And so, maybe it's at 400, maybe it's at 250, but the path it takes to get to that over a year, there's quite a bit of it's tough to nail down, especially if you're in month 3 of production. And so it could be, 1,000 barrels a day, 900 barrels a day, 750 barrels a day. And so you've got to make a guess of how that, let's see if I can see it on the screen. So it's not going to go in a straight line. It's going to start off, and then that decline is going to slow down. And so how quickly that decline shallows out is what's called your B factor, essentially. And if you are too optimistic on your B factor, it could have a huge repercussion on your reserves that you're estimating and your cash flow stream. So if you're off a little bit, you could be off, the difference between a 1.1 B factor and a 1 B factor after 2 months could be a 30% difference in your reserves. So if you're not careful there and you're not doing your due diligence, looking at existing wells that have more production and seeing, okay, what's their initial decline? What does their B factor look like? And taking an average of those similar wells, nearby wells in the same formation probably want to keep it within the last couple of years, because how completion techniques change over time. If you don't do that research and apply it properly to your new well, you could be way underestimating it. You won't be able to buy it because somebody's going to sell it for you for that. Or you could be way overestimating and you'll never make your money back. Newer wells are certainly riskier, just because the risk, of missing the forecast is greater. If you've got an older well that's been on a 5, let's say even 10% annual decline for the past 5 years, there's not a lot of risk in that other than the well just going down. So it's not like that trajectory that it's been on is going to change a whole lot.
So a couple of things. One thing you hit on there that I thought was interesting was the idea of differing completion types, and typically it's advancements and completions get better over time. So like a completion in 2014 might have a different B factor or decline profile than a completion in 2021. And so, these are some of the reasons why you really kind of have to know your stuff. It's not just as simple as, oh, we've got these other, control points over here. Well, it's like, what's the vintage? Who drilled them? What do they do? There's really I would almost, when I hear you, when we talk offline and we look at different opportunities, it's like you're a forensic investigator. There's so many different things that you look into, and it's not just, I think a lot of people want to oversimplify these things, but there's a ton of rocks that you need to uncover if you really want to have a good picture of things. Why don't you talk about the operational side too, looking at like individual wells. And I know in the past you've talked about how you can almost tell from what's happened in that well's production life cycle if there were like downhole issues or other problems, and just maybe speak on that topic for a while.
So looking at the production profile, or looking at historical production, if you see production go down every 18 months, you know that you should probably expect the well to go down every 18 months. You know, you're kind of looking for patterns. So things like that, you know, every time a well goes down, depending on how deep it is and if it's on what kind of artificial lift it's on will determine how much it will cost to bring back on. If you're looking at, you know, if you're able to have 12 months of lease operating statements, typically you can see, you know, it was costing $2,500 a month to operate it every month, except this one month where it was $25,000. Well,
yeah,
if it's $25,000, they're probably having to send out typically there's a dollar limit where they have to ask for approval to do it. But let's say it's $15,000. That's typically under the you know, request or proposal limit. So you know, there was probably a rod part or something where they had to go back in and fix it. And so, you know, if you see one of those and what you're evaluating, it's probably safe to assume that will, you know, one rod part a year is not that, not uncommon. So factoring that into the operating cost would make sense. If it's something different, like, I don't know, they went and installed they bought new equipment for the location that was a one-time deal and won't be a recurring maintenance item, then you could probably write it off and say, okay, well, I shouldn't count this into what the monthly operating cost should be. But did that answer the question?
It's a really interesting rabbit hole to go down, because I think in the ways I've seen you do it in the past, there's kind of like this high level look, the sniff test, right? You're just going to sort of get an approximation like, hey, you know, all these factors holding constant, this is probably the range that these assets are worth. And then if it gets serious, and let's say like you lobbed in a bid and the seller was like, hey, I like this bid, you guys want to move to next steps. Now you're like, okay, well, I need to really dig in, like under the example you gave earlier, if it's like 100 wells, now you're going in, right, and you're looking at each one of these forensically and trying to understand, like, what story is that well telling, right? Like, what's the story of that well from when they brought it on to now?
So I might have, at that preliminary stage, I might have taken the net sum of all the production and forecasted that as one unit and take it, you know, so put it all together as treated it essentially as one well. And so your net production, you can't take like your average well times your average production and get your net production. It's a weighted average, right? If you've got a well that you own 10% that's making 100 barrels a day, that's 10 barrels a day. And then you've got another well that's also doing 100 barrels a day, but it's at 2%, that's only 2 barrels a day. So you're at 7 barrels a day, right? So you've got to do that for all the wells in it. And so like a high level evaluation would be to take that weighted average, you know, get your net production, forecast it out, kind of tie it to the accounting as best you can. Typically I'll just do that in a simple Excel model and see, you know, one, can I get my model to tie, and then how do I want to, you know, proceed forward? And typically that works really well on like older, that's kind of what my next bullet point there is. If it's older, steady production, you can be comfortable probably just doing it off a cash flow multiple, and that's more of like the real estate model, right? On a yield basis. What is it going to yield me, you know, over the next 12 months, 24 months? So if it's constant, that's a simple to model it out and try to figure out, okay, if it's making $1,000 a month, I think future it'll probably continue to make $1,000 a month. I'm comfortable getting a 2-year payout on that or 3-year payout on that. So you can pay a cash flow multiple of that, but you want to make sure that you can get everything to tie together, the accounting and the production, and feel comfortable with what's being presented to you. And if you can do that, then doing something like a cash flow multiple is more palatable. Producing minerals typically trade for a pretty high cash flow multiple, like sometimes 60 months or more.
Wow.
Wellbore only would be lower on a cash flow multiple, just because there's no potential upside. And all this is totally irrespective of there being like real measurable upside in the future. If you're in the middle of the Permian and they're doing 12 wells per section and there's only 3 drilled, you're going to have to pay for those other 9 if you want to buy that opportunity.
Let's talk about upside for a little bit, get into that. And like, I know that's a whole section that you had, but it starts to get a bit more nebulous in my opinion, and just a little bit harder to evaluate, maybe more risk, depending on where you're at, but go into some of your methodology and things you look at when trying to figure out if you should pay for upside, how much you should pay for.
Definitely. Can we touch, I have NGLs on we talked about it earlier. Let's wrap that up real quick. Okay. So NGLs make it more complicated in evaluating the value of your gas stream. And like you said, typically you have zero visibility into it. And, oftentimes what I'll just do is I'll take what is your net revenue from your gas stream, your NGLs plus your gas revenue, and divide it by the wellhead gas. So, what's your total gas revenue between the two? What's your wellhead gas? And sometimes what's on the statement isn't even wellhead gas because it'll be shrunk due to processing. So you have to use the public production data in order to kind of get your true wellhead number. And then, so your total revenue divided by your wellhead gas kind of gives you what you're actually realizing, and then do that realized number versus strip pricing historically, and then that gets your diff, for the gas and in the NGL. It kind of combines it all. It's not perfect, right. But it's you want to value that. Like, you have to value that if you typically want to be able to, you could be missing 10% of the revenue if you're not valuing that NGL stream by putting it back. The easiest way is, like I said, just to put it back into the gas revenue and figuring out your net dollar per MCF.
And it can be tricky with NGLs because not all barrels are created equal. This gets more into kind of my domain around midstream and marketing. And it's like, you can have a barrel that's got a lot of ethane in it. And that means that, ethane is typically a lower priced product than the heavier components. It goes ethane, propane, you got your butanes and your C6 plus, and these are like natural gasolines is what we call them. And those are going to be probably more correlated to the price of oil versus maybe ethane or propane that have other factors that drive those pricings, whether it be seasonality among the weather. That's a big one with propane. Ethane, you've got takeaway capacity and frac capacity downstream. So fractionation, not hydraulic fracturing, just in terms of cracking the product, taking the products out, sending them to a cracker. So within that barrel, there's a bunch of different product streams. And so you kind of need to have a sense of where you're at, what the gas composition for that well looks like. That's a really good piece of data to have, is that, what type of barrels are these? And then some other things that throw people off are the yield that comes out of the well. So for example, if it's yielding so many barrels per million cubic feet produced, and then that could change. Well, why would it change? There's reservoir reasons why it can change, but there's also things like, for example, ethane elections, whether you want to recover ethane or reject ethane. So this is an option you can build into your gas contracts that gives you the ability to tell the processor or the midstream company, hey, I want to recover the ethane, which I want my barrel to have all of its components, or the majority of its components, up to where my set recoveries are at the plant. Or if the price of gas goes up, which is methane, which is C1, and the price of ethane is down, you may say, look, put this ethane into the gas stream up to the limit that we can do to meet quality specs for the pipeline. And then you can sell your ethane as methane in the natural gas stream. And what happens then is that your yield goes down. So you're getting less barrels coming out of the gas. So people may look at that. This is a common thing. And guys are like, well, why did my yield drop off? It's like, oh, well, we went into ethane rejection. And then the other thing is that the price per barrel goes up, because now you take that lower priced product, which is ethane, you've removed it and put it into the gas stream. And so that barrel that you're left with is the heavier products, which are typically priced higher. So your price per barrel goes up, and then the yield goes down, and people are scratching their heads like, how could this possibly happen? Like, what changed? Did something change in the reservoir? And you're like, no, these are commercial things that are changing. So there's a lot of nuance around NGLs, and it's a whole topic that, we could do a pod on, but it's something you have to understand.
Yeah. And that's why there's so many variables in it that, 90% of the answer with 10% of the work is doing what I was talking about doing, where you're just taking how much are you making off the gas stream, gas plus NGLs divided by your wellhead volumes, and just kind of run it from there. And sometimes, like you said, you could be above the basis, NYMEX or hub could be $3.50 and you could be realizing $4. It's not always the case. I was looking at one the other day where they were barely making any money to process it, actually. So it was costing them like $3,500 a month to process, and they were getting like $4,000 in
because there's costs associated.
Revenue, so.
There's costs associated. You have to pay processing fees. There's a plant fuel involved, and there are times when your gas stream is on the bubble. So let's say it's 1,100 BTU or under 1,100 BTU. You may be butting up against whether or not it's economic to strip the NGLs out. People will do deal structures called like a keep hole, where they basically, the producer or the midstream company keeps the NGLs for themselves, and you're kept whole on the heating value, but in the form of methane. And then you can maybe avoid some of those fees. So there's different structures there, but it's not, to your point, it's not always profitable to strip the NGLs out. If the gas is very rich, if it's 1,300, 1,400 BTU, then odds are it makes economic sense to take those NGLs out, but that's not always the case depending on the quality of the gas. Gets back to that gas analysis point that I made earlier, like understanding the quality and the composition of maybe offsetting wells, or ideally the wells that you're trying to buy.
Right. Yeah. And typically that's available. Like if you ask for a gas analysis, or, sometimes they'll give it to you, I guess, a gas analysis or the settlement statement from the gas purchaser. And then you have everything you could want. You could see, the fees, and that you can calculate your diffs because it shows you what they were getting for the residue gas. And so it's much easier to do it that way, but that's not, especially if you're a mineral owner, they're not going to typically provide you with that information. So
it was funny story around that. Like when I first started in the industry back in 2010, I was working as an intern at Williams Midstream, and they thought it would be a fun project to give me to go out and try to sniff around and find gas composition and gas analysis up in the Marcellus. And this was when it was a relatively new area. And they're like, oh yeah, like, go try to find this. And so I was like cold calling operators. And even we had an affiliate, WPX. I don't know if it was called WPX at the time, but the Williams Upstream, whatever they called it, before they spun it out. And I would like to even talk to those guys. I'm like, hey, can I get some gas analysis? Because we're trying to design a processing plant and figure out how we need to service this area and like what the quality of gas was. And everybody was like, no, like go pound sand. Like, we're not giving you that. Some like 20-year-old kid, like calling up all these operators being like, can I get a copy of your gas analysis? And everyone was like, no. Yeah. So it can be something that is, especially in an emerging area where people are still buying, still leasing, and there's still that land rush you mentioned earlier. This is not always the easiest data to get, but if it's a mature field, you can probably scrounge one up somewhere.
Right.
So, all right, move on to upside.
All right, upside. Man, upside's tough. Yeah. So like I was talking about earlier, if you have new wells, you're having to build what's called a type curve, where you're seeing, what does the initial decline look like? What is the B factor? How do these wells shallow out? In addition, on pure upside wells that haven't been drilled yet, what's the start rate look like? They're starting 1,000 barrels a day or 1,500 barrels a day. So those are all things that you create with what's called a type curve, where you're taking analogous wells, and you need to be careful with which wells are analogous. There's a lot of things you've got to take into consideration. Are they in the same formation? Are they in the same vintage? Are they completed, which would probably mean they're completed similarly. Sometimes certain operators are better. A lot of times there's kind of a premier operator and they do things the best. And so, if you're buying under a premier operator, you know, that's great. If you're not, maybe you shouldn't take the other operator, the better operator's wells into consideration. It all depends on data concentration. So if there's a bunch of wells around you, it makes it easier. It's easier to cull wells out. Core of the stack or Permian or something like that, it's a lot easier. There's just a lot more wells that you can pick from to build your type curve. Sometimes it can be difficult, especially if people are drilling multiple formations or multiple benches within a formation. A lot of time, like in Oklahoma, there's probably 3 or 4 landing zones that are all called Mississippian. So that can be tough. You might have to look at the actual depths of the wells to pick out which ones you want to use for your type curve. But at the end of the day, what you're doing is, picking analogous wells that you think are most similar to the wells that will be drilled. Are the wells around you all single wells in sections, and is a pad fixing to get drilled? Because if a pad's fixing to get drilled, odds are those wells won't be as good as the ones that are by themselves, as a parent well would be. So, those are all things that you've got to take into consideration when creating this type curve. What you do with the type curve is just like what you were doing with the existing production and running a discounted cash flow model, except for one additional variable, which is timing, which is tough. So if it's a DUC, if it's a well that's drilled and not been completed, you can look and see how quickly has that operator, and all this data is really, you've got to find it somewhere, and something like Drilling Info sounds like a plug for them, but it's probably the easiest place to get something like that. So you can see, when was the well, when did they start drilling it, when did they complete it? You can look through a number of wells that they did and kind of come up with an average of the time frame between when did they spud the well, when did they start drilling it, and when did it get completed. So let's say you're buying minerals under some drilled uncompleted wells, and historically the operator takes 6 months from spud to completion. And so you see when the well started drilling, you start the production 6 months out. Because it's a discounted cash flow model, timing is huge. If the production comes on in 6 months versus 12 months, that's a very large, especially when you're buying upside, because you're paying typically a higher discount rate. So like a DUC, you might be paying PV 20 to 25 or something, because there's that unknown of where that well will start producing exactly, the volume that it will start. And there's also variable on the timing. So you want to pay a higher discount rate. And when you're paying higher discount rates, it makes the time aspect of that value proposition very important. So that's why, like, DUCs are kind of your most known of the upsides. And then like a well in progress that's actually being drilled, that could be a 12-month type, 8 to 12 month type lead time from when the well started to when it's completed. And then, beyond that is permits. If you've got a permit, there's, high likelihood, hopefully, that well gets drilled. You just don't know the timing. Typically, if you get a permit, you've got to drill it within a year. So you can use that, kind of that knowledge to set your start date on on those new wells that you're going to be producing. In each category, like each, going from DUC to well in progress to permit to just future upside location, each one of those, you're probably paying a higher and higher discount rate, where, maybe like a 35 to 40% discount rate for just an unknown timing future location, where you might put the production starting out 3 years from now, but that's probably kind of the discount range that you're going to be paying in. A big component of upside is also, what is the ownership going to be? Is the unit, is your ownership in this unit, are they drilling a 1 mile well or a 2 mile well? Like, is your ownership in the well that you're buying in a 1 mile unit, but they're drilling a 2 mile unit now? Well, your ownership is now half. It all kind of works out because the well's twice as long, so the reserve should be about twice as much. But anyway, those are additional things to think about, and nailing down that ownership can be pretty tough sometimes, but that's where a landman helps out.
Yeah, absolutely. Talk about like parent-child and spacing and some of the games that people can play. You look at some of these areas where maybe it hasn't been fully developed. And so you may be thinking there's this many wells that could be there, but there's really, you think it's ABC, but it's really XYZ in terms of how they develop it. But maybe speak to that for a little bit.
Yeah, that's why it's important to have look at announced wells, based on how many are being drilled in a unit. If somebody's drilling 10 wells per section and 12 are being proposed in the unit that you're buying in, I would bet that the 12 wells on an individual basis, on average, will not perform as well as the operator doing 10. And there's different reasons for doing that. I mean, they could just be trying to accelerate. Some operators are trying to create inventory, although that's less and less the case, it seems like these days. But one could be trying to create more locations for themselves, and one could be trying to drive single well returns. You want to be buying under the operator that's driving single well returns for sure. But you just want to make sure, you've got to be careful with how many wells are getting drilled, because some operators are still trying to, in developing plays, they're trying to figure it out. There's a risk, it's unknown, I would say. If the ultimate spacing is still unknown or being tested, it's risky. All you can do is base it off of, hopefully there's something to base it off of. If there's another unit that's got 5 wells drilled in it next to you, and your unit's getting 5 wells drilled in it, then, you've got something to go off of. If not, I'm not sure, as a, non-operated party, I would feel super comfortable buying in it, because there's something that the operator will have a bunch of proprietary data. Maybe they shot seismic. Maybe they drilled a vertical well and have some logs, and they there's a lot that they could know that you might not know. And there could be different purposes for the reason why they're drilling that. It could be a test to try to drive something and not drive their own data or understanding, and not necessarily the returns of that well. So something to consider.
Is there like a sweet spot these days? I mean, I know maybe in the past, when things were blowing and going and acquisitions were happening more larger scale, people were putting tons of value on that upside and, buying it specifically for that inventory. Whereas now maybe your people are risking it more. And there for a while, when we were kind of in a bear market, people didn't really want to pay for any upside. They just wanted to buy production. Do you think, like, if somebody's, say, like a private equity team and they've got an asset, they have to try to strike the balance between how much have we already developed to get the cash flows up to an attractive level versus like how much can we sell to somebody in the future? Is that a fair comment to make around trying to figure out the best way to optimize your program
Right.
to then, if you want to try to exit the asset?
Yeah, I think so. I think it's a tough balancing act for sure. It seems like, I'm kind of out of the private equity operator game. I have been for a little while, so I can't speak real firmly to where that sits right now. But I would say from, mineral and non-operated perspective, it seems like people are more willing to pay for upside on a mineral override than they would be on working interest. And I think a lot of that is because of the working interest is cost bearing. So not only do you have, the variable of production, but you also have the variable of cost. And that's a good segue into one of my next points is CapEx. So if you have a working interest, and you're trying to value upside, you've got to know how much those new wells are going to cost. And some good sources of that would be like public investor presentations, typically talk about their costs. There's a good chance they're light a little bit, but it's something to go off of. Sometimes recently that's becoming more, last few years has become much more and more prevalent, where somebody has bought a lease, maybe they couldn't flip it. They were holding on to it. And then somebody comes in, proposes 10 wells, and that person who took that lease doesn't have $3 million to throw at the next 10 wells. So they'll try to, they'll sell that opportunity to participate in those wells. And if you do that, you've got the capital cost right there in that AFE, that authorization for expenditure, which everybody will create one and submit it, with a well proposal. If you own a working interest in that unit where the wells are getting drilled. So, so the CapEx is important to keep track of. And then kind of the last capital item would be plugging and abandonment, which, could be $30,000 to $60,000, maybe a little bit more, depending on the depth of the well. And, but that's something that comes at the very end. So, if it's newer wells, it's probably not really, when you discount that capital exposure out 10, 15 years from now, it's going to be very, very minimal. If you're buying some older wells, where it might be, maybe it's 5 years out potentially. It's also a good negotiating tool as well. Like, I got to factor in the plugging into this, you knock 10 grand off of it. You can use it in that way as well. But kind of those are all the pieces of the puzzle that I could come up with in my little outline here
So to talk real quick, the last thing is on the plugging and abandonment and the liability at the end of the well. You just touched on it for a second, but speak to that for a minute.
Yeah. So when a well no longer ceases to produce economically, the operator kind of walks away essentially, and depending on the state and the governing body, the responsible thing to do is to plug and abandon that well and remediate the site back to, essentially back to its native state. So I think the state of Texas says if you've got a temporarily abandoned well, you've got to plug 10% of your inventory of abandoned wells per year. It comes more into play if you're buying like a big package and there's a bunch of, older wells in it, or that's kind of what you're targeting, older cash flow. You might be able to get it for real cheap, that maybe you can get it for 18 months cash flow, but you can get it for 18 months cash flow, but maybe you've got to plug a few wells 3 years from now.
Or a bunch of wells.
Or a bunch of wells, yeah.
Right. And so you have to take that liability into account. So it's like, all right, not only what's the future value of these cash flows in this asset, but what's the future value of those liabilities? Bring that back to time zero, and that factors into your bid, right?
Right. Yeah. And that's, I've built that out in Excel models before. It's not too bad. You just kind of take like, this is how many wells are abandoned. I think this many or uneconomic. I think, every 6 months, 4 more will become economic. They're not going to plug all those 4 right at that point in time. So you can kind of spread it out. It ends up not, most of the time it ends up not being super material. But it's definitely work. Like, you need to factor it in for sure, or at least run the traps to see if it's significant, to factor it in. Maybe you don't have to go get real granular on it, unless you realize, oh man, this is I'm buying $1 million deal, and this could be worth, plugging will end up costing me $200,000, and then you probably ought to study it a little bit harder.
There's like a life cycle of an asset. If guys aren't plugging wells and doing it the right way, that liability can build. And there can be a crossover point to where if guys haven't done it correctly, that asset becomes a liability in total, because the future value of the cash flows may not be enough to cover the total liability. And you see that where guys kind of cling on to assets for a long time, or you've got a situation where there's a big non-op package. And since you're non-operated, you don't control it. And because it's spread across different operators, maybe they have different methodologies of when they plug. And so you might look at a package and it's like, cool, 50 producing non-op wells, but there's like another 100 that are non-producing. And then you're like, oh, do I really, is this value there, or is there any value there?
Yeah, that's a really good thing to keep an eye out for. Yeah, you might get a list of the producing wells, but what's the entire inventory of wells that you're taking on? And are there a bunch of abandoned, temporarily abandoned wells in that? So yeah, that's a good point.
What about, just real quick, I know we're over an hour here, but just the process of when you go to do a deal, things like the, signing a PSA or like the steps that you go through, and then real quick touch on some of the requirements if you're an operator in different states and things like that, like actually the nuts and bolts of, okay, I got it, I won the bid, now what?
Yeah, it depends on how you're buying it. I mean, if it's through EnergyNet, you essentially have to pay and close when the auction ends. If it's not, I mean, the typical process is you send a letter of intent with an offer, you haggle back and forth a couple times, get the LOI signed, and you have some period of time to get a purchase and sale agreement executed. So, let's say you get an LOI agreed to, you've got 15 to 30 days to get, if it's a bigger deal, maybe 45 days to get a PSA agreed to. And then, another 15 to 45 days to close post PSA signing. If you're an operator, you've got to be bonded in the state that you're planning on operating in, and there's a few ways to go about doing that. That's kind of the
there's like transition periods. Sometimes there's prior period adjustment, like, hey, we're going to stop at this date, but if anything happens beyond that, it's on the buyer. If anything happens that was longer than that, or it's on the seller or whatever, there's some nuances there when negotiating these things.
Yeah, that made me think of something really important. There's production date and there's accounting date.
Right.
So typically there can be a pretty big lag between production date and accounting date. So you could be getting October accounting, or let's say where we are now, January accounting, but it's for November production. And so when you're making a bid, you want to be, depending on what side you're on, like you want to be very specific as to, is this accounting date or production date? If you're on the buy side, typically you want to make it production date because let's say you close in March, but you'll get like 2 or 3 more months of production because of how, I'm trying to make sure I'm saying that right. Just be careful and run it both ways on accounting date versus production date, and at least know what you're getting into, right? So you're evaluating it properly.
Yeah, and for people that don't know, I mean, the lag there is because you actually have to produce the volume. So the volumes have to produce. That's done within a production month. That you have to measure those volumes. You then have a purchaser that pays you for those volumes. There's other accounting things in there as well. Sometimes a purchaser can net everything for you. Other times you may get invoices from like a pipeline or, whoever it may be. And so then you have to do all that accounting. And so there's just like, you have the production month, and there's typically a month of like running through the traps of all the accounting and getting everything right before, the revenue gets paid out. And so that's just something to keep in mind that you're in a lag, you're in arrears typically. Yep. But man, we've gone over an hour. This is super interesting. And I think like you hit on all the stuff at a high level. Maybe in the future we can go back in and dive deeper into some of these topics, but hopefully people, at least got a sense for how complex these problems are when you're going to make these types of investment decisions, and that you really need an expert or someone like Taylor that can help you with it. But anyways, that's the last thing we'll say, but give a plug for Mockingbird. What's some of the work that you guys do, or if anybody is needing help in this department, what's a great way to reach out and contact you guys?
Yeah, you can reach out to us. We've got Mockingbird Energy Partners. We do, this wasn't the intent. I didn't want to make it sound overly complicated, although there's a lot of variables that can make it complicated. It doesn't necessarily have to be. If it's a simple cash flow stream that's steady, it doesn't have to be overly complicated. But obviously once you get into upside and new wells and timing of all those things, it gets real complicated, complex real fast. So
yeah, we're making it like super complicated, but the reality is there are plenty of people that buy properties and it's as simple as, here's the cash flow stream. They want it. Their investors want it. The seller says, here's the bogey you have to hit, and they pull the trigger. And I think this happens quite a bit in the oil and gas industry. Yeah. If you want to win, a lot of times, in any bidding process, it's like the winner's dilemma or whatever they call it, where you kind of have to maybe not overpay, but you have to be aggressive enough to get the transaction done, or the seller just won't sell. And so there are a lot of people, especially in the mineral space, that I found that, when we try to educate around marketing and, the revenue side, and they're like, I don't, they don't really care, right? They're like, this is market. Market says I got to pay this, and if I want to win the deal, I got to pay this. And so this is just like best practices stuff that we're talking about, right? It's not necessarily how it's always done.
What we talked through is why Wes and Jeff call me Dr. Death, because I kill a ton of deals. Because if you go through this level of detail, you see where the risks lie, and you put a number to that, and not every time are people, other people necessarily doing that. And so, maybe you don't win a ton of things, but what you do end up winning or owning, you're probably going to be pretty happy with, barring, global pandemic or something like that. But yeah. So, if my email's Taylor@mockingbirdep as in energypartners.com. I'm on Twitter. I mean, I have a Twitter handle. I'm not necessarily on Twitter. And I'm not sure I could tell you what my Twitter handle is. Although I think, Max, you tagged me in one of our
I'll tag you in this.
I think you turned me into a meme on one of those ones where I was staring, with great passion at a Bitcoin miner, I think. So
yeah, that's good. All right, well, that's a great way to end it, Taylor. Thanks again. Hopefully the people that listen or watch this found it insightful. If you need any help in this department, hit Taylor up, and thank you guys. We'll see you, Taylor. Talk soon.
Sounds good. Thank you, Max. Bye.